Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, we're seeing something we didn't see all of last week, and that's stocks actually dipping today.
I know, but it's early, and we could go right back to that winning streak.
We could rocket into the close. Let's get to the biggest stories right now in the more than $21 trillion global ETF industry. Markets on this Monday being driven once again by headlines. President Trump telling Bloomberg that it's, quote, highly unlikely he would extend the two-week ceasefire if a deal is not reached, and said the Strait of Hormuz would remain blocked until an agreement is finalized.
As investors grapple with this geopolitical volatility, we speak to two high-profile guests. Andrew Gosden, partner at Apollo Global Management, joins us to discuss PRIV, the private and public credit ETF.
And in just a moment, we will speak with Michael Barron, co-president and portfolio manager over at Barron Capital, the firm gaining attention after throwing its hat last year into the arena of actively managed ETFs, plus the firm's holding of SpaceX. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. We have probably as bullish of a leaderboard as you can get. March was rough, all right? The leaderboard was a lot of gold and like short-term treasuries. Look at this. Q's at the top and SPY. These two are interesting because these are like trading crowd favorites. A lot of institutions, hedge funds type, they love to get quick exposure with these. IVV and VU are more retail, right? And then DIA for good measure. I mean, you've got the whole U.S. market here, both traders and retail, like both jumping in. After a rough March, April seems to be clear. The market likes it. A little bit into gold, which is maybe contrary to that a little bit, but gold's been really a momentum trade, I think, recently. And then some money into semiconductors as well. Let's look at the outflows. And again, this is pretty bullish, right? To see Bill at the top. This is a ultra short-term treasury ETF, it's like holding cash. And then some money out of Soxel, that could be people taking profits. A lot of times in the leverage ETFs, if it goes up, they quickly sell to lock in the profits. That's probably what that is. And then SGov, also treasuries, right? So this is where we saw people piling in March. They were like very scared. Now they're leaving. More on that in a minute. Some money out of the Qs. And then here's a RSP is interesting. That's equal weighting. This is a big trade at the beginning of the year, but mega caps may be performing again. People are less interested in that. We'll see. Let's look at the cash-like ETFs, right? This is ultra short-term treasury ETFs, which a lot of people run to when they're nervous, right? This is where you want to go on the sidelines. So here's a look at the flows by month, right? And if you watch the show, we went over this peak here in March Madness, right? This was a $53 billion flow into cash-like ETFs. People scared. It's a record. But look at April. People are leaving, right? I know April's not over, but even if it camp a little bit, you see it's either back to normal or even lower. So this tells me that a lot of people are getting back into the market, Katie, feeling much better.
Yeah, you also saw an outflow from money market funds, but we know tax day just happened. We'll continue to watch it, though. Eric, thank you. Joining our conversation now is Michael Barron. He is co-president and portfolio manager over at Barron Capital. Michael, first off, great to see you in person.
Thanks. Thanks for having me.
Let's start with Barron Capital and your entrance into ETFs, because you've been known since 1982 as an old school sort of stock picking mutual fund shop, but you entered ETFs late last year and you really meant it. I mean, you hired a team and you're up to 6 funds in total. Talk us through that process of deciding, this is a place we want to enter, and what the strategy coming into it was.
Sure. Like you said, first of all, thanks again for having me. As you just mentioned, we are old school. Old school not necessarily in the formats that we use, but in terms of the research that we're doing. Each one of our strategies, each one of our investment philosophies has stayed relatively consistent since we were founded back in 1982. That's being, true fundamental growth equity analysts and trying to find great companies that we can own for the long term. We're thinking about years, 5 years, 10 years even. As you mentioned, though, we've become almost known as a mutual fund investor. Still, mutual fund is an amazing format for many of our strategies. It allows people to transact at NAV, get access to less liquid securities, works well in retirement programs. But we're not only focused there. At Barron Capital, we have a true mission of changing the lives of our clients. In order to do so, we need to meet them where they want to be met. And ETF wrapper is one of those areas. They've been asking us for a while, can you provide your strategies in an ETF format? And about 4 months ago, we decided that we could. And we launched our first 5 ETFs in mid-December. And we launched our most recent ETF earlier this month, Emerging Market Select ETF.
So which strategies work better as mutual funds versus those that you can expand to ETFs? How do you think through that?
Sure. So we're really looking at which of our strategies and the underlying securities work best in the format. So we're trying to say, is there liquidity in these names? Would it work into this kind of format? And it has. It showed in that really how I'm judging our success isn't necessarily in terms of the assets that we're able to gather in each one of these strategies, which we've been very successful off the bat, having over 650 million in these 6 strategies, over 400 million of flows since we've launched. But really, I want that service to be excellent. And service excellence really, to me, means keeping that spreads as tight as possible. Only a few pennies wide currently. And we're really seeing that across our board, and we're seeing investors utilize this in the right ways, meaning that they're coming in and they're staying with us. They're not just trying to do this as a quick trade, but they're really thinking about this as an investment for the long term.
So RONB is the ETF, but it's based on the Barron Partners Mutual Fund. I became acquainted with this fund over the years, and our analyst David Cohn went back and looked. Is there any mutual fund beating the Qs? Because the Qs is ridiculously hard to beat. You were in a handful of names that beat it. We said, why? We look back. You just let Elon do Elon. I mean, basically, Tesla was a small holding, but you let it get big, and now Tesla's 26% of the portfolio, SpaceX is 28%, so Elon's like 55%. So just 2 questions on that really was just like faith in Elon still, because he's controversial, and then the second thing is just basically not cutting your winners. You know, Cathie Wood is similarly a fan of Elon, but she would always cut after it went up to keep the 12% weighting. You didn't, you let it run, it worked out.
Yes, Elon is controversial in the news. He's not controversial with us. We really like him, believe in the team that he has around him, whether that's both in Tesla and now in SpaceX. You got to remember, we started investing in Tesla back in 2014. It took us over 2 years to actually build that position. And we started investing in SpaceX in 2017. And there's obviously a lot of news out there right now in terms of what the potential could be in terms of an IPO. Not that I have any great insight in terms of the timing or the pricing, but if everything I'm reading is progressing as on track, this is still just a stepping stone for this business. SpaceX has so much more potential than where it is today in terms of the launch business driving costs down, with the communication business with Starlink and more satellites, what they can do with the combination of XAI and providing that kind of AI training up in space.
And it's interesting. I mean, you think about how RONB holds SpaceX. You own the shares directly, but we've seen this basically cottage industry of all these different types of vehicles, special purpose vehicles, for example, that purport to own SpaceX. And you're seeing some of that come into the ETF wrapper as well. You know, I wonder your broad thoughts on that, those different access points, given that, you know, this is a company that you've owned for a long time, and in this case, you own it directly.
Yeah, I think our access and relationship with Elon and the management team has provided that level of access. We obviously like the business. We like where this is going. As we were talking about earlier, we try to own businesses for 5 years, 10 years, decades. Really, what can this business become over time, not where it is today. And I was saying this is just a stepping stone. You know, we'd be at the prices that they're talking about, we'd actually be buyers at this kind of price, you know, considering what they can become over time. And I think that's attractive for a company to say, hey, these are investors who really want this business to fulfill its long-term objectives, its mission. These are mission-driven businesses, whether it's Tesla, whether it's SpaceX, XAI. What can these businesses become? And we're true believers in their ability. And you know, each and every day we're out there talking to the company, talking to management teams, ensuring that the competitive advantage of this business is sustained, and in many cases actually getting more enhanced, that we are believers that this can become, you know, what we think is going to be over time.
So I'm semi-optimistic and even pretty liberal on adding these private companies into ETFs. There's a baby step process going on. You have SpaceX in here. Might you add Neuralink, right? Because Neuralink is a private company that people are really interested in. It's currently in the ARK Venture Fund and a couple other interval funds, but not in an ETF yet. Could you maybe add that given your relationship with Elon?
It's something that we've looked at. It's something that we've studied and researched. We don't own it yet in any of our strategies, mutual funds, or ETFs, or separately managed accounts. But as you were asking earlier, you know, we're trying to place the security. First of all, does it fit the Barron Capital criteria? Does it have the growth objectives that we're looking for? Does it have the competitive advantage and the management team that makes us excited to own something for the long period of time? And then it's finding the right vehicle for it. And something like SpaceX is a unique case in terms of the liquidity that historically has been there while it's been a private company. Neuralink, I'm not so sure if it has that kind of liquidity, and we would place it in the right structure that matches that liquidity.
All right, Michael, really appreciate your time today on this Monday, and happy birthday, by the way. What a place to spend your birthday at Bloomberg HQ. Our thanks to Michael Barron of Barron Capital.
Thanks so much.
Now coming up, we speak to Andrew Gosden of Apollo Management about the PRIV ETF and the firm's role in the fund. That conversation up next. This is ETF IQ.
This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today this is one that we talk about a lot. PRIV, depending on who's doing the calling here. I think they're going to call it PRIV, but anyway, it's for private credit. State Street IG Public Private Credit ETF. Okay, here's what it does. About 80% of it is public credit, 20% private credit. Normally, you can't have more than 15% of your fund be illiquid, which is private credit. But because Apollo is involved and they're providing the backstop liquidity-wise, they're able to get beyond that 15%. And this was a very sort of revolutionary product. It's been out a year now. It's got 55 basis points of a fee. It's got 835 million assets, and you can see 14 months old. Let's look at what it holds. You can see a lot of treasuries in here. Fannie Mae, Freddie Mac. Down here, some corporates. So it's going to be a mix of things. 329 total holdings. Let's look at the performance. That's what really matters here. And this is where the differentiation comes in. It is differentiated, but not by a ton. So here's the performance here since it launched, 6.6%. Okay, good. It's beating the ag and it's beating LQD, which is IG corporates. And then this is high yield. So it's underperforming high yield. So they would argue probably that you get investment grade, but a little more juice than these investment grades, but not as risky as high yield. That's sort of what it's going for here. So far, again, $800 million, not bad. Interesting ETF, Katie, that we're going to talk about right now.
Eric, thank you. And you're right. Joining us to talk about this ETF is Andrew Gosden. He is a partner over at Apollo Management. Joining us on set, Andrew, it's great to see you.
Thanks very much for having me.
So let's talk about the different roles here, because Apollo's name isn't in the name of the ETF. It used to be, now it's not, it's a whole story. But talk to us about, what State Street does, and then what is Apollo's function when it comes to serving PRIV. PRIV is how I pronounce it, but.
I would agree, PRIV as well. There's a big controversy about that, though. So Apollo, as the world's largest alternative credit manager, is originating the asset that State Street then has the option to buy. And if State Street in the ETF in PRIV buys it, we guarantee the liquidity against that. But I would say, taking a step back more broadly on liquidity, I think that is sufficient to make the ETF work. But from our perspective, we wanted to bring in a broader consortium of trading counterparties that would actually make this work more efficiently for underlying investors. And so we went out about 18 months ago to 5 sell-side bulge bracket, well-known name brand banks, and said, come trade private investment grade with us. And so in that context, State Street now has the ability to come to Apollo to seek liquidity, or they can go to one of those 5 bank counterparties in that consortium. And so we are really trying to develop this secondary market in private credit, and I think we're on that journey.
And to create that liquidity so that it's easy to access at any given point. How big a selection of private credit instruments are you offering to State Street? Is Apollo basically handing over, saying, here's what's available?
We're originating about $300 billion a year in in total origination across our ecosystem. The vast majority of that origination can be shared with firms like State Street, and through our strategic partnership, they have identified the investment grade segment of the market where they're really interested in buying either corporates or asset-backed, explicitly rated investment grade instruments that Apollo has originated ourselves. And so they ultimately decide, State Street that is, decides to make the investment themselves, and then again, we create the liquidity against that investment.
Let's talk about differentiation, because this is where I sometimes wonder how much this can resonate with ETF investors. I get why institutions like this, they can do that nuance, like with Sharpe ratio and all that, but advisors in retail, they tend to look for shiny things or cheap things. So your yield is 4.5%. It's returning in the ballpark of LQD. So it's like, what do I need this for when I have all these other types of bond ETFs I can get similar numbers from? What would you say?
So look, I think what's really novel about this is we have created a first of its kind public and private ETF. And really our thesis is, how do we think about disrupting the core plus category, where 20 to 40% of that category's portfolios are invested in public high yield. So in PRIV, we replaced the public high yield exposure that would otherwise have been found with private investment grade. So from our perspective, that's better risk, better return, and lower volatility because we're more senior. And so therefore, we can outperform that, those peers in that category and have done so by about 80 basis points, as you put up on the screen slightly earlier. And so I think the thesis has played itself out. Top performance, really interesting conversations with investors around the world, and I think it's starting to resonate as we go through the process.
Well, I want to talk about where you stand right now, because your total assets in these ETF above 800 million. You're just about a year into the game here. I do wonder, though, given that it is a first of its kind ETF, what are your ambitions for this fund? And I mean, to put it bluntly, are you surprised it's not bigger?
Look, I think we believe this is a category killer. We are certainly off to the races. The thesis is really sound. We have been validated by a large institutional asset owner who's one of the most sophisticated fixed income investors in the world. The conversations are resonating across channel, institutional, wealth, insurance, and so on. And so I think the prospects for the success of the ETF are high, but we would say in our first year, we've had incredible performance, good capital formation, and I see a strong pipeline for us building the portfolio over time.
Let's just pull back that chart of the net asset growth, because I think it shows something that's really interesting here. There's two spikes in that chart as opposed to kind of something that builds over time. And I'm wondering how organic this growth is in assets.
I think in our first year, we've had a variety of dialogues with investors around the world. This is a novel product. I think the evolution of the market has probably outpaced the investor education. And so in the context of this portfolio, really what we're talking about is private investment grade, not the $2 trillion market that is getting all the headlines today in private credit. Really, this is the $38 trillion segment of the $40 trillion total pie in private credit that is focused on the investment grade side of the market. And so we are on a journey, and it's our mission to educate the market around private investment grade and the fact that this is actually a safe yield, interesting replacement for core plus, and really isn't a high yield exposure. And so we're on that journey, and I think that conversation is ongoing.
30 seconds. A lot of people cynically would say, well, if Apollo's getting in, they just want to have exit liquidity. This would be what somebody would say, like, why are they so interested in sharing this with the rest of it if it's so good? What would you say to that?
I'd say our view is we've been on a journey for liquidity for the last 18 months to 2 years. We believe that liquidity, transparency, and ultimately sunshine in private credit is good and net beneficial for investors and the industry. And so we own, principally, everything that State Street selects in the ETF. So we can't necessarily guarantee a good outcome every time, but we can guarantee the same outcome. And we are not offloading our credit to this portfolio. Rather, we're actually sharing in the fruits of our labor and our origination.
All right, Andrew, that's a good place to leave it. Really great to get some time with you. That is Andrew Gosden of Apollo Management. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. This is Bloomberg. Now it's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. Joel co-hosts the Trillions podcast with Eric, and he's also the head of games at Bloomberg, which is, again, just charming. Joel, what do you have for us?
3 questions, I hope. Let's get down to it. Question number 1. About how many companies in Vanguard's Total World Stock ETF, that's a biggie, have changed their names over the past decade? This comes from a research note from Bloomberg Intelligence. A, fewer than 200. B, around 500. C, around 900. Or D, more than 1,500.
Oh, boy. I'm going to go with B.
Just like dartboard. Let's just throw it up and see. Okay, D.
I feel like it's either A or D to go to both sides of the spectrum, so I'm going to go with A.
Okay.
Yeah, no, this is an insane question, by the way. Sorry. Yeah. I mean, I'm going to go with C, because why would you pick 9? That's a weird number to
C
throw in
is
there.
correct. You kind of saw through the little bit of the clue I tried to give you there. You can thank Athanasios Seraphigas for that one. All right, question 2. It was a little too stumpy. Okay. Who is the largest ETF issuer in Asia by assets under management? Is it A, Vanguard, B, BlackRock, C, Nomura, or D, Amova?
I'm going to go with C.
I'm going to go with B.
When in doubt, BlackRock.
Okay. Scarlett, you're on the board.
Whoa!
Hey. Nomura.
I don't know if that's right, but okay.
Bank of Japan.
The Japanese
Bank
government
of Japan
owns a lot of
single-handed for
ETFs.
that.
Who wrote that one?
That came from Asia. That was Rebecca Sin with.
All right, I'll follow up on that.
This was heavily influenced by Bloomberg Intelligence, as is this last question.
Okay.
Let's see how we do here. Under President Trump, this is both term 1 and 2. Which day of the week tends to see the weakest performance for SPY? Is it Monday, Tuesday, Wednesday, Thursday, or Friday?
Thank God it's not 24/7 trading yet. A, Monday.
I'm going to say Friday.
I'm going to go Thursday.
Reading his own research.
Yes.
D, Thursday.
This is also insane, and it's also from Athanasios.
Yeah.
Oh my God.
It was a fun one. So if you like more of this, go to Quiz Go on the terminal, and you can also play Pointed, where we let you play around with some weightings, get some points, and have some leverages. You
Are
can
we going to do
3x on
leverage
some
for
of
our
this.
quizzes?
We're still working on it.
All right.
I don't know if you would have wanted to do any leverages today. It might have been a
I
lot
would
of
have gone
hedging.
big on the last one.
A lot of hedging, I think.
I was completely goose egg for this week. I don't know if that's happened before. So
Oh, it's a good feeling.
what happens if you
It's happened to me.
leverage? Oh, I guess you lose a lot of money.
Yeah, we got to bring the
3x0 is
rankings
still
back
zero,
up.
though.
That's true. That's
right.
true. All right. Our thanks to Bloomberg's Joel Weber, Bloomberg's head of games. And yeah, it's going to be interesting to see when we do apply leverage, just how much pain we can really put ourselves in. But coming up, a new memory ETF could have the biggest thematic debut ever. The firm launched this month. It's already hit $1 billion in assets. We're going to have that conversation up next on ETF IQ. This is Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are falling. That's after a turbulent weekend in the Middle East cast doubt on prospects for peace talks between the U.S. and Iran. President Trump telling Bloomberg News that it's, quote, highly unlikely that he would extend the 2-week ceasefire with Iran if a deal is not reached before it ends. He also said the Strait of Hormuz would remain blockaded until an agreement is finalized. Meanwhile, oil prices are sharply higher as geopolitical tensions ramp up and traders begin pricing in the risk of supply disruptions. In company news, American Airlines shares are moving lower after the carrier rejected United Airlines' proposal for a merger that would have created the world's largest airline. The stock is also facing pressure from rising oil prices as investors weigh the potential impact of higher fuel costs amid ongoing geopolitical uncertainty. Elsewhere, shares of Commerce Bank are higher. That's after the German bank formally rejected UniCredit's latest proposal, saying it lacks value and undermines trust. Tomorrow, UniCredit CEO Andrea Orcel will appear on Bloomberg Television at 9 a.m. UK time. And finally, QXO shares are declining after the company said it will acquire TopBuild for approximately $17 billion. That creating the second largest publicly traded building products distributor in North America. Analysts are broadly positive on the deal, though some said it was unexpected. And coming up, we'll be speaking to QXO's CEO, Brad Jacobs. Those are your midday movers. I'm Nora Melinda.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with IGV. This is BlackRock's software ETF. It was really in the mind of the markets when we were having that SaaS apocalypse. But take a look at what happened last week. This is weekly performance. The fund gaining nearly 15% last week. That was its best performance going back to 2001. So we'll see if it can keep the momentum going. But software gaining, XLE, it's a totally different story if we take a look to what's going to happen over here when the chart comes up. But anyway, there we have it, XLE. You can see that it's wiped out all of its gains that it accumulated since the war with Iran began, now down about 0.9%. But I want to end with a newcomer on the block, and that is DRAM, the Round Hill Memory ETF. It launched this month, about 10 days ago, actually, and already, Scarlett, its assets have passed $1 billion. So, wow, what a start.
Absolutely. Let's talk more about this right now with Jake Silverman. He is a semiconductor analyst at Bloomberg Intelligence. And when it comes to DRAM, the ETF, this all goes back to that idea that memory chip makers are the next wave of the AI excitement. This was not the case 2 years ago. I mean, memory chip makers really took off in late 2025. What does that say about where the DRAM cycle is?
Yeah, the DRAM cycle is definitely in its sort of boom phase right now. We're in an extended upcycle. If you look at past historical cycles, typically they last somewhere between 7 to 10 quarters. We're already well beyond that, and based on guidance for some of these companies and the trajectories of these companies' earnings, it's estimated to keep going for quite a while, and a lot of that is just driven strictly by AI demand, but also a supply-demand imbalance that's driving upward pricing moves.
Yeah, let's talk about this ETF again. I looked at the top 4 thematic ETFs of all time. It took them over 1,000 days each to get to $1 billion. So when I see DRAM come out and get to $1 billion in 10 days, I'm like, what is going on here? What's interesting to me is the 3 stocks, SK Hynix, Samsung, and Micron, are really not easily gotten. They're not either in ADR format or in other ETFs. Round Hill saw an opportunity here. Talk about those 3 names. How dominant are they in this particular market?
Yeah, those 3 names take up or account for the vast majority of memory demand, both for DRAM, which is the name of the ETF as well, but also NAND. And so a couple of key aspects to think about is high bandwidth memory is what's driving a lot of the AI demand. And SK Hynix is by far the leader. Micron has been a share gainer. Samsung is looking to take back some of that share with HBM4 and the upcoming NVIDIA GPUs. So it's really been these 3 that are very dominant in the space and will continue to be so based on their capacity for the foreseeable future.
So is it safe to say, I mean, when you take a look at the portfolio, the collection of names that this ETF holds, that this is representative of the industry at this moment?
Yeah, it's very representative of it because there's really only a handful of companies that really dominate the space, and a lot of that is from a result of a lot of consolidation and bankruptcies over the last several decades. So it's stabilized a bit over the last couple decades, but now it's really 3 main suppliers. But then you can include other companies in there like SanDisk and Kioxia. They have a JV to do research, development, and manufacturing as well. So if you really include those 2 additional companies, you end up with 5 real main players.
It's pretty remarkable. You look at SK Hynix, Micron, and Samsung making up 75% of the ETF on their own. For SK Hynix, we're talking about the Korean shares, but this is a company that may launch ADRs as well in the U.S. So do we assume that the ETF would then invest in the ADRs as opposed to the Korean stocks?
I'm not sure how some of the mechanics might work, but at the end of the day, I wouldn't expect the weighting to necessarily change all that much if we were to just kind of look at it from like a share aspect in terms of the overall memory market. Yeah.
Yeah, I think DRAM, if the ADR comes out, it takes a little shine off of DRAM. But at that point, once it's liquid and going, people know it as the memory ETF. I mean, it's pretty much good from here on out. I think one of the things that I thought was interesting about what you've been writing, because I didn't know anything about this, I had to go to him and get all the information. And you see 75% growth. So this industry of memory is $75 billion currently, but you see it going to $135 billion in only 2 years.
Yeah, that's specifically high bandwidth memory. So one of the things about high bandwidth memory is not only that it's specifically driven by AI demand, but because it has higher wafer requirements compared to a standard DRAM wafer, it's reducing some of the supply of the standard DRAM. And so it's causing an incrementally tighter market pretty much every single day as you keep pumping out these HBM wafers, because there's just not the amount of capacity added is not keeping up with the actual amount of demand. And that's driving this price increase that we're seeing. pretty much daily, although now if you look at spot pricing, because the trading is so thin, it's not necessarily indicative of what we're seeing in real time.
I still go back to the idea that this is an actively managed fund, but there's 11 holdings in here.
Yeah, they got around it because Micron, they use a swap contract, and that's how they're diversified. ETF issuers are very creative.
I guess so. It's remarkable. An 11 holding ETF that's actively managed. All right, Jake Silverman of Bloomberg Intelligence. He is our go-to guy on all things semiconductor. That does it for our check on DRAM, the ETF that's just grown. Coming up, a conversation with Wells Fargo's CEO Charlie Scharf. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu. It's time to take a look at the Bloomberg Intelligence Traffic Light System, which ranks ETFs by risk level. So green light means low risk, yellow light means moderate risk, and red light means high risk. Eric, what do you have for us today?
Today we have PSIL, which is the Advisor Shares Psychedelics ETF. Very interesting one. This thing launched and went right down. Like, it's been in the doghouse for a couple years, and I thought, man, if any good news comes out, this thing could really pop, and it just happened. Today, Trump basically did an executive order expediting research and access to these types of drugs like MDMA, ketamine, mushrooms, which are help to cure depression. This is the kind of regulatory, it's kind of like cannabis in that way, regulatory issues really get it going, and this thing traded 6 million today. That's 6 times its average. So big day. It gets a green light, but with one, it is actively managed, but otherwise, it's a long-only stock ETF.
That's really interesting. I mean, yeah, you take a look at the share performance today. I see the shares of this ETF currently higher by about 10.5%. And, you know, it's funny, given the volatility, I mean, these things almost trade, they kind of remind me of biotech stocks in terms of how responsive they are to regulatory headlines. But a green light for this fund.
Yeah, I did some research into it. There is a lot of growth potential, but regulations are a big deal, and how do people access them? But just anything that's down that much, any good news can really give you a lot of pop, and that's why some people look for these kind of trades. Same thing happened with cannabis. Uranium had the same deal about 4 years ago. So anyway, this is one where you probably have to see more, but this is definitely a step in the right direction if you're someone who is watching this.
Yeah, and a lot of small cap stocks, to your point about biotech, right? Atai Beckley is the biggest holding here. It's a pretty small company. All right, Eric, thank you so much. PSIL, PSIL gets a green light in the Bloomberg Intelligence Traffic Light System. We want to go now live to the Economic Club of Washington, where David Rubenstein is speaking to Wells Fargo CEO Charlie Scharf. Let's listen in.
A little controversial, because this always comes down to, like, well, what should the president be able to say and what should the president be able to do? There's no reason, in my mind, why the president shouldn't have a point of view. All presidents have for a long period of time. They've done it in different ways. This president does it very vocally in terms of what his points of views are. But even as it comes to, who he's choosing to nominate for the Fed, in this case, he's chosen someone who has a point of view on what's going on in the world, AI, what it's going to mean for jobs, what it's going to mean for productivity, and that's his point of view, and it's got to be approved by Congress. But this idea that there's total separation is just not true.